Ladies and gentlemen, good day and welcome to the conference call for analysts and investors for post-results discussion for Quarter 2 Financial Year 2020-22-23 Arvind Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer. Thank you, and over to you, sir.
Thank you, and good afternoon to all of you for joining us in this call to discuss the second quarter results of Arvind Limited. Joining me today is Mr. Jay Shah, our Executive Director and Group CFO, Mr. Swayam Saurabh, Chief Financial Officer of Arvind, and Mr. Kaushal Shah, Head of Investor Relations. Before I get into specific results, just want to share a few observations around the macro environment in which our businesses are operating today. From our vantage point, the export markets continue to be volatile. As we scan through the results, disclosures, and guidances issued during August-September timeframe, most of our key customers, the messages we have picked up indicate a clearly weakening demand outlook given the inflation issue and the interest rate hike. While many of the revenue numbers for the key brands have been near flat or even shown minor increases, they indicate an underlying volume degrowth because behind those numbers are price realizations which are higher. Secondly, the Russia-Ukraine war continues to take its toll on the European brands and retailers. Many have reported store shutdowns and consequent loss of revenues and volumes. As we are hearing in the media, India is being an exception. In our industry as well, most of the large domestic retail players in fashion and apparel space have reported 40 to 60% growth in their Q2 results. This also indicates a continuing shift in demand from the unorganized to the organized players in our country. Some of the momentum was related to the festival season buoyancy after 2 COVID-impacted years, and this is expected to continue well into the wedding season starting this month. On the cost front, input costs have certainly been on a downward trend. Cotton prices, which had crossed rupees 1 lakh per candy, are now quoted between 60 to 70,000 rupees per candy and still stay volatile. We expect them to continue moving in that range in near future. Other input costs have been on the lower side as well, especially the ones which are imported from China or elsewhere are enjoying the benefit of reduced inbound shipping costs. Energy prices continue to stay firm. So in this macro context, our Q2 performance was broadly steady and flat. Overall revenues were up 3% and our EBITDA was up 1.5% compared to the Q2 of last year. Operating margin from continuing operations was 9.3% compared to 9.5% in the Q2 of last year. Profit after tax before exceptional items stood at rupees 85 crores and final reported PAT was rupees 125 crores. Our note clearly explains these one-time adjustments which arise from the sale of our interest in Arvind Internet, which we had announced last quarter, provisions for potential losses in trade receivables from our water treatment business, and potential loss in land sale related to one of our land parcels. Textile revenues were up 3% at rupees 1,758 crores. Woven and knitwear fabrics saw steady volume, while denim volumes saw a sharp decline. Garment volumes were also lower than planned at 8.1 million pieces as our customers continue to defer their buying given the uncertain demand outlook and to some degree continuing inventory correction. Price realizations increased by 38% for denim and 24% for woven fabric categories. AMD continues to do well. The revenues were up 5% in Q2 of FY22. But if you take a overall H1, because in last year, what happened is that a bunch of deliveries had spilled over from Q1 to Q2, and hence, an H1 is a better comparison. So compared to H1 of last year, this year H1 is 20% up in terms of revenue growth. And this is very much in line with the full year guidance we have provided earlier for this business. So we continue to get good traction for all AMD products across the board. As an example, our composite business has started supplying parts for this Vande Bharat program, train program, to the coach factory. And we're executing the first order, which was about 80 crore rupees. And we expect subsequent phases to continue coming to us as well. AMD margins have improved to 12.3% as input cost pressures have also eased a bit and help continue scaling up these businesses. Overall, our operating discipline remained quite tight, and this helped us achieve a reduction in working capital requirements as well. Net working capital turns improved from 5.6 turns in Q1 to 6.1 turns in Q2. Looking forward, we see demand environment for textile exports, especially, to continue to remain uncertain, while domestic demand will be robust, especially in Q3. AMD should be on track to deliver 20% growth in H2, as I said before. Overall, softening prices and a weakening rupee should start contributing to our margin numbers, especially in Q4. We continue our plan to reduce the borrowing, especially the long-term debt. So far in this year, we have reduced the long-term debt by 83 crore rupees, and we should kind of reduce it by almost 300 crores by March 2023. So this concludes my opening remarks, and I now invite you all to ask questions. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. We take the first question from the line of Mr. Abhishek Nigam, B&K Securities. Please go ahead, sir.
Hi. Thank you so much for giving me an opportunity. So, a couple of questions. First, I do understand the demand is what it is right now, but US was having a bit of a pipeline issue in terms of the inventory which got piled up over there. Is there some sense that you have in terms of, is that getting cleared out now? And could that sort of, provide some support to demand in the coming months? So that's my first question.
Right. So it is, we definitely expect the inventory build-up in US to start to improve. It's just that entering into Q3 right now, we don't have complete visibility on when would it normalize. Our current estimate says by mid of Q4 is when we should see a normal level of inventory fully return.
Yeah, actually, to start to get more clear once we have the holiday season results out.
Okay, so basically sometime in January or so.
We have a better visibility around that time only.
Okay, fair enough. Yeah, I do understand that's a very evolving situation. The second question that I have is, in an overall and macro environment which is kind of getting tricky and tough, what I'm actually seeing is, okay, raw material costs are lower, logistics costs, container shipping costs, those are sort of, normalizing lower. So, first half, these were sort of the talking points on why margins were suffering. And so these are now sort of getting better. Demand I do see as a sort of maybe at a stable level now. So, but these things should translate into EBITDA margin sort of moving up from here on slightly, or do you think that it will probably be just remain where it is right now?
So, other than these two factors, and the first one also includes cotton, which at this moment is extremely volatile. To give you a reference, historically our business has been at about 29 to 30% of, let's say, gross margin, which has now shrunk to closer to 25%. We do see that perhaps in next 2 to 3 quarters, we start to inch towards these margin levels, and those improvements should start to reflect in EBITDA.
Fair enough. That helps. Last question from me. Just on the debt side, so are there also any progress on the land sales, or is this debt reduction just coming from the operating cash flows?
Right. So, we have now, as on H1, we have collected close to 40 crores of cash, which is essentially the advance which is coming out of land. And we have maintained that we should get about 100 crores, which should basically contribute in our overall long-term debt repayment in this year. We think we are broadly on track.
Perfect. So that's 100 crores by the end of this year, is it?
Yes, correct.
Yeah, 40 we have got, another 60 we expect. So for a full year basis, we expect 100 crores to come in from the land sale.
Okay.
Out of the total expected 300 crores, so 200 crores will be from the operating cash flow and 100 crores from the land sale.
Okay. That's it for me. Thank you so much.
Sure. Thank you.
Thank you very much, sir. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone phone. We take the next question from the line of Prerna Jhunjhunwala, Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. The performance has largely been, great in terms of margins, is how I read it. But I would like to understand what helped you to achieve better performance on the margin front in this quarter, because the demand was weak and costs were high. So could you just explain how you managed a 9.5% kind of margins in this quarter, whether it was purchase of yarn, lower price yarn that helped you in this period, or whether it was higher realizations from earlier order books, and going forward we should expect some contraction on realizations going forward. So just wanted to understand the business environment a little deeper.
Sure. So first on Q2 results, by design, a large part of our revenue is sort of, part of an order book which is frozen in advance. So we do have visibility of, 1 to 3 months forward, which is how we indicated in the call, that Q2 will be a bit muted, which is what we have largely delivered. What we also see going into, Q3 is looking at our order book. We expect the performance to be, at a similar level, slightly muted from these levels given the uncertainty. Deferment of a number of orders we see, for example, some orders from Q2 moved out to Q3, and we will have to wait and see if customers are actually picking those volumes which we forecast right now in Q3. But balancing all of that, we do expect, while the external factors remain uncertain, given that we have better price realization also supported by currency, we would largely have similar quarter going into Q3 basis what we see right now.
Okay. And are customers revising your existing orders based on the input price correction, or it will only happen in the new orders?
We think there is a larger play from demand side, as Samir explained in his opening remarks. The US part of market, which is fairly large for us, all large, brands and retailers are sort of, in the phase of reducing inventory which has been built up for last 2 quarters. And that translates into sort of lower order book, for us going into quarter 3, also partly in quarter 2. This is one reason which would keep quarter 3 flat. Other one is this energy crisis in Europe and general economic sentiment around it. So while we do see new order and also see repeat order, we think these are the two factors which are sort of counterbalancing our total order book, which translates into a flattish quarter which we see ahead.
Okay. I have a question on garments. So in the garments business, we were quite confident that our Q2 is not seeing any major pressure, but our volume suggests that we witnessed pressure in the garments business also. So though you've highlighted that there were pressure in the key markets, could you give some sense if there was how was the profitability in the garments business, and should we expect similar volumes in the garments business also?
No, so let me address the profit part, and Samir can come in on volume. Profitability, if you look at H1, we have delivered about 9% EBITDA, 9 to 10, which is low single digit. We expect that to improve going forward also in future quarters. As far as volume is concerned,
the volume is really a result of deferment of orders. It's largely tied to what we told you about the US market still adjusting their inventory, looking at a not so strong demand outlook, and hence most of the key customers, if you see their commentaries also going forward, they're all revising it down. 1 quarter back, they were all lot less pessimistic, but all the disclosures in September time frame talk about revising it down. So it's a result of that they have deferred a bunch of orders. And on the supply side and capacity side, we have shared in the past that we are shifting part of our capacity from Ethiopia. So that's a work in progress as well.
But it's largely customer deferment, a combination of inventory equalization as well as partly Europe situation, which we think will start to normalize as we go into quarter 4.
Okay. Last question from my side as of now. On provisions for water treatment business in Ethiopia. So wanted to understand the nature of this and whether it is done for the entire receivables, or we can see any further provision on that front again.
So let me explain the background to this. Our water treatment business has executed 4 projects in Ethiopia over last 3 to 4 year time frame. And the nature of these projects is that they were installed as common effluent treatment plants in industrial parks. So Ethiopian government has been for last 5-6 years pursuing a strategy of economic development basis light industries like textiles, pharmaceutical, light electricals and so on. So they have established multiple industrial development parks where they invite tenants from across the world to set up factories. In 4 of such parks, our effluent treatment solutions were chosen as the CETP solution, Common Effluent Treatment Plant Solution. So we've installed those, and in some cases we also had the contract to operate those. Now the expectation was that as these parks get populated with tenants, and their monthly fees of the tenants will pay off all the investments and the other payables which were committed by the government. Because this whole plan sort of fell apart with this whole civil war and law and order and political situation, that whole chain of expected events did not play out the way it was designed to be. And hence we kind of got into this situation, and we expect that actually things are resolving there and some of this money might come. But as a prudent step, whatever is potentially the full exposure, we are taking that as a provision right now. We don't expect, there is no more amount to be kind of discussed. It's in fact, some of it may not fructify and create an actual loss.
We've just been very, very conservative.
Okay, so we can see write-backs also going forward from this amount.
Yes.
Okay. Thank you and all the best, sir.
Thank you very much. A reminder to participants, anyone who wishes to ask a question may press star and one on the touchtone phone. We take the next question from the line of Mr. Sagar Parekh from One Up Finance. Please go ahead, sir.
Hi, Samir, and so decent performance at least on the margin side. A few questions from my side. One on the denim side, we have seen volume decline both on exports as well as domestic. Exports, I understand, as you said, on different reasons in US and Europe, but on the domestic side, I'm pretty surprised to see decline in volumes. So if you can explain that, and going forward, how should we think of denim volumes for Q3 and Q4? Q3 will be similar, about 13-14 million pieces. I mean 13-14 million meters, or do you think that worst is over for denims?
Right. So on export side, denim is largely impacted by inventory buildup in US, which has translated into customers like Gap and few other deferring shipment till they clear inventory. And within the denim portfolio, US has a very large percentage of revenue, which is one large reason for this impact. This, we believe, is also temporary. Once inventory starts to clear up, we think this should start to normalize perhaps later part of quarter four. Then there is another smaller impact in export, which is related to European energy crisis, where we see some of the brands slowing down the order intake, but we will have to wait and see. Although this is not very large as US, but we will have to wait and see how quickly this can normalize. On domestic front, we see a pretty unique situation. A large volume of our domestic goes into trade, and from there it gets supplied to mid-tier value brands, which are neither Levi's and Pepe nor mass market. What cotton prices has done is taken their basically USP away, in the sense that the differentiation is less, while these brands' ability to take price hike to maintain their margin has come down because of the input cost going up. That's where we see a volume shrinkage. And as cotton has started to normalize, although it is still very volatile, we do expect that this should correct itself in next 1.5 quarters, and this would follow how cotton normalizes.
So in terms of volumes, the quarterly volumes for denim, can we expect pick up now going forward, or you still think that?
So as I said, these three large reasons: European energy crisis, we will have to wait and see. We do expect some positive uptick in US market going into quarter four. And the domestic, while we have shown that we could compensate part of the volume loss by moving into other channels, but it will entirely depend on how quickly cotton goes back to stable normal level. We are hopeful that in next 1.5, 2 months, cotton should normalize, and once that happens, then you should see that improvement as well.
Okay, got it. My second question is on the you mentioned that on garments, your profitability was 9 to 10% in H1. Did I hear it correctly? Just the questions that Prerna asked on the garment side. Did you mention that the profitability for H1 was 9 to 10%? And we expect the profitability to improve from H2 onwards?
Right. So, what I referred was actually textiles. Garmenting are, at low double digit right now, which we expect to inch up as our factories are better loaded. As our factories are loaded and as volume picks up, we do expect this to go closer to double digit.
We expect the margins to go to double digit in H2 then.
That's correct.
Fair enough. And how should we think of overall volumes for garments for the year? So I think H1, we are still seeing some growth in terms of garmenting volumes. We will still be growing for FY23 or?
So in value terms, we believe we will have a growth. Volume as the single largest reason is deferment of orders, which we also see continuing into Q3. We will have to see. We believe quarter 4 onwards, the volume should start to get better. That's how we see right now. Samir, you want to add something?
Yeah, I think on the full year basis, we should be broadly in the same zone as last year because of all of what we are going through. I don't expect any significant change in a full year number.
Fair enough. My last question would be on the CapEx. So we have done about 100 crores CapEx in H1. What should be the CapEx number for H2? And have you finalized any plans for PLI scheme for governments as well as for advanced material division yet?
Right. So on a full year, we expect to be between 150 to 180 crore range. That's our current visibility for this year. On PLI, we have, taken all initial preparatory steps, including, the process of formation of company. But we are still internally sort of finalizing our capital allocation, also given that, businesses like AMD, which is very attractive, and finding that balance. So perhaps in the next quarter call, we will have more clarity on CapEx for, next year or so. And of course, when PLI 2 comes, we will definitely apply.
Okay, got it. Thanks. Thanks a lot. That's it from my side.
Thank you very much, sir. We take the next question from the line of Mr. Amit Kumar from Determined Investments. Please go ahead, sir.
Yeah, thank you so much. My question was, just answered. So that's it at my end. Thank you so much.
Thank you, sir. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Samir for closing comments. Thank you, and over to you, sir.
Sure. Thank you all very much for joining us today. We'll meet you in one more quarter. Thank you. Bye now.
Thank you.
Thank you. On behalf of Arvind Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect.